My name is Vibhor. We have recently come out with a new sector report on IT services sector. We remain highly positive on the sector as we have been for the last 2 years. Over the past 5 months, we have seen the IT services sector in India correct significantly and has significantly underperformed the broader index. Most IT services frontline stocks are down 15 to 40% from their December 2021 levels, which has led to a significant correction in the investor wealth as well. We believe that this correction has largely been driven by what we call top-down fears, or majorly the macro fears. Things like high inflation in US and Europe, volatile commodity prices, and the latest being the fear of recession in US. All these have put a weight on the cost of capital, which has actually gone up significantly, and also at the same time it has put into question the ability of the corporates in US and Europe to grow, spend, and hence the growth of these IT services companies itself has been put into question. All this has led to this significant correction, especially in the valuation multiples. Now, why do we say only valuation multiples? Because if you see over the past 5, 6, 8, 10 months, the EPS or the earnings estimates for most of the IT services companies have not changed. Only in last quarter we saw a couple of companies whose earnings were downgraded, but otherwise they have largely remained intact or in fact have been upgraded. So the large part of the correction that has happened in the stock prices of the Indian IT services companies has largely been driven by a derating of multiples. Now we believe that we should be, if not at the bottom, then very close to the bottom. There are multiple anecdotal data that suggest that the demand environment continues to remain strong. If you look at the Gartner forecast for the next 4 years till CY25, they continue to forecast 8.9% CAGR growth in the global IT services spend, whereas historically in the last 10 years it has only been 3.2%. ISG continues to see the highest deal flow data across the segments that they represent. Accenture remains extremely positive on the overall demand environment. Companies are very, very positive, and in fact, the clients, the potential clients of all these IT services companies, be it the BFSI sector or the retail sector, they are all talking about an increasing tech spend or a continuing the levels of tech spend which they had last year. So while all these anecdotal data evidences point to a very strong demand environment, the fear of recession definitely cannot be ruled out. This is one overwhelming fear that is plaguing the entire IT sector at this point of time. On that front, we believe that the important point to note is that a recession, as ironic as it might sound, is always good for Indian IT services companies. You look at the GFC crisis. When the crisis hit, the Indian IT services companies' revenue was hit, the market cap was hit, but the pain lasted only for 2 quarters. And the reason for that is very simple and logical. Recession forces companies to cut costs. And what better avenue to cut cost than to outsource a non-core function like IT to an outsourcing vendor who can subsidize your cost by using their offshoring model. We don't expect any different outcome this time if and when there is a recession. Whenever there is, I think there will be a couple of quarters of pain, but then the growth in the demand environment because of cost takeout measures will actually be even more than what we and the street are expecting pre-recession. So net, even if there is a recession, there could be a couple of quarters pain, and your holding period could at max be expanded by 2 or 3 quarters. But we are quite confident that in the years succeeding the recession, the growth is actually going to be higher than what one would have imagined pre-recession. So net, what we are trying to say is that all anecdotal data evidences point to a very strong continuing demand environment. Even if there is a recession in the worst case scenario, the pain should not last for more than 2 to 3 quarters, which will be more than compensated for by the growth in the subsequent years. And lastly, if you look at the overall tech adoption cycle, the corporates that have embarked upon their cloudification, digitization journey over the past 2 years, they are not going to immediately put that on hold or take that to an abrupt end. The digitization is not a part of cost takeout measure anymore. It is imperative for every corporate to grow. Retail companies need to have an omni-channel presence. BFSI companies need to be able to connect to their customers through different platforms, and that is something they can't just avoid. So corporates will have to find the money even if there is recession, if they intend to be competitive and if they intend to grow in their own businesses. So IT services now has become an integral part of all these clients' expenses, and that is what gives us the confidence that the spend is going to continue irrespective of whether there is a recession or not. So net-net, we are very strong on the demand environment and the earnings growth momentum. The only thing that remains to be discussed probably now left is valuation. On the valuations part, as we mentioned, I think the stocks have derated significantly since January, and since earnings have remained intact, large part of the correction can easily be attributed to the derating of the multiples. We believe a large part of the valuation derating has already happened. The current PE multiples lie between the pre-pandemic average multiples and the during pandemic average multiples. Now, we firmly believe that the pre-pandemic multiples are not something which can offer a good benchmark. They can at best be a floor, but they cannot be a benchmark for what future valuations should be, because the growth environment is completely different. Pre-pandemic, if stocks used to trade at 17, 18 times, but they were delivering an earnings growth of only 10%. Today, if the stocks are trading at 25 times, but they're delivering growth of more than 15, 16%. So if you look at that, I think the PE multiples need to have a reset in any case because of the strong demand environment which is expected over the next 3 to 5 years. So we believe a large part of the correction which had to happen in the valuations has already happened. On the peg level basis, most stocks are already in line with what they were trading pre-pandemic. So we see very limited downside, if at all, in the valuations from current levels. In fact, we see significant upside potential in some of the key stocks in the sector over the next 1 to 2 years, and that is what is leading our confidence in the sector. Our topics in the sector remain Mphasis, Mindtree, L&T Infotech, TCS, Infosys, Coforge, and Persistent. Thank you.